Real estate is a great tax advantage because you can take depreciation and create some losses, right?
Right.
But it's a passive loss. And for most people, they don't get to take those losses because they don't have passive income to offset it against.
Right.
So I want to be this rep, right? Because I want to be able to take that loss and call it an active loss and offset it against my W-2 income or my business income or anything else that I've got. Again, document, because if you don't get to take that active loss. It remains a passive loss and you don't lose it, but it's hard to use it.
Yeah.
Right.
Yeah, absolutely. I mean, I don't have much more to contribute to that. I mean, seek the professional guidance to make sure you're qualified. But yeah, as Rick was alluding to, basically passive losses can only be offset by passive income as a whole. They have these phase out provisions based on your AGI and things like that. And we won't get into details on that, but the real benefit is like Rick said, right? If you have depreciation now, it has taken that, what would have been normally considered a passive loss, negative. Now you don't have the ability to offset that on W-2 wages or any other active income unless you become a real estate professional.
Right.
So that's really where that is. Rick, I hate to do this to you. I'm going to let you're such a, this is your expertise. The short-term rental loophole that's associated.
Yeah. So this is, I tend to think of these as the Airbnb deductions, right?
Yep.
Okay. So, and there are a couple of short-term rental loopholes. Okay. You could be using the Augusta rule, which is a short-term loophole, and that is the 13-day rule, right? So if you just have and that has to be your main home. That's not a rental property. That is your main home that you're renting out for whatever. Maybe you go on vacation and you want to earn a little bit of money, and so you rent your house out while you're on vacation. You can use the Augusta rule for that. But this is typically for that person that's the Airbnb-er that's like, I've got this beach house and I want to do, weekend vacations for people to come in and do stuff. Well, most of the time, those are considered to be more like a hotel than they are a traditional real estate property. Well, that's actually, there's some benefits to that because that means that if I have a loss, I'm not running a real estate rental property. I'm running a hotel that's an actual business, which I'm going to file on Schedule C rather than Schedule E, which means if I have a loss, that's an active loss.
It's an active loss. That's
and
right.
I can take that straight off of my W-2 or any other business income I want. So that's one of the great things about it. Now,
and you don't have to be a real estate professional for that.
Right.
Yep.
And you don't have to be a real estate professional. The only problem with that is if you don't have a loss, you have net income. Now I'm subject to self-employment taxes, right? And so that's where we look at you and go, okay, well, maybe you need to be an S corp then.
Yeah,
right.
Absolutely. Things to consider, like we talk about material participation. Are you materially participating? Shorter rental periods applies to rentals that would stay shorter than any specific time frame, often 7 or 14 days.
Yep.
If it's a long-term tenant in there, it's not going to qualify, guys. Okay. So like I say, record keeping, state and local regulations must be adhered to. And overall, like if you're operating as a short-term rental, it's going to qualify as active income or active losses. But like I say, sit down with a tax advisor like Rick or myself, and we'll help get you guys navigated through that.